residential properties got hit first and hard.
Yes.
Just like my story with that apartment building, I didn't start to see multifamily again transact, unlock, unfreeze for about 2 years.
Sure.
So I was doing all houses and, residential loans like duplexes and the like for 2 years. And then all of these apartment buildings started to crater. Alrighty, folks, you are in for a treat. The day after Christmas, we have the head of research for Macro Edge Real Estate, Ulysses Awesome, with us. And he's been on the show before. It was a blast. We had a good time. We learned a lot. We agreed and disagreed on some things, which is always a fun conversation. Ulysses, merry the day after Christmas. How are you?
I'm back at you. I'm doing well, thank you. How about you?
I'm doing well. I think we should spend just a little bit of time talking about 2024, what surprised us, what we got right. But I do want to spend a lot of time on 2025 because I think there's a lot of variables. There's a lot of gotchas out there if we're not careful. But why don't we talk about 2024 and what you got right, what you were surprised by, and maybe we'll talk about a couple things we got wrong, which is always fun.
Yeah. Well, I guess I'll start with what I got right. The 30-year mortgage rates going back up.
Yeah.
At the end of the year, we expected that. That's something that we watch closely over at Macro Edge. Just comparing it to past cycles, I don't think that going into next year it's going to be at least what I've read a lot of people talking about. But that definitely did not surprise us this year. One of the things that did surprise me this year was how well public home builders actually moved homes. I did not expect them to move as many as they did this year. It definitely was difficult for them, but they have done a good job making sure that they are meeting prices and incentives to get things out the door.
Yeah, there's
a lot of salespeople working overtime.
They definitely figured out how to get to the right payment to move the product.
Yeah, absolutely.
Yeah. It's funny you brought up rates. Something I've acknowledged before and I'll acknowledge here. I got rates wrong at the early part of the year. I think it was really through July, maybe even August. It went that far. I was like, you know what? We might see the high fives.
Sure.
I was in that camp, but then I saw what happened after the first rate cut, and I'm like, oh no, this is going to be different. And quickly reversed and said we were going to 7. And well, one thing I've called for 25. Just want to see how this lands with you is. I'm telling people I think the 30-year mortgage rate is going to average 7%. Sure, we might get in the high sixes, some part of the year, but I think when you put it together, we're going to have 7% next year. Am I in line or offline with what you're thinking?
I don't think you're far off. Actually, we just recently made a call for Lance Lambert over at Resi Club, and we firmly believe we're going to have a long stretch of sevens. My call was for annualized, so just the year average was 6.4, 6.5%.
Okay.
I think we're going to start the year really high, and as the year goes on, we're probably going to see that retrace back down to the lower end. But still, 6.5 to 7% mortgages for next year. People should not be surprised to see those numbers at all.
Yeah, I think that's wise advice, and we'll talk a lot about that because I think there's. I feel good about my call through the summer, but there's so many variables that could change that and really cause rates to fall in the second half. So that'll be a fun conversation. One of the things that I did get right was the continuation of the crash in transactions.
Yes, right? You've been all over that.
Yeah, and prices not so much, right? Prices again are up slightly, right? Again, something I called for the year. It's just. I don't know if you spent any time looking at the period from 1978 to 82, but it feels like we're walking the same dance, right? Transactions are falling, rates are rising. And I think there's a lot of people that thought, as rates rise, 1% prices have to come down. And that's just not how it works, right? It hits transactions long before it hits price.
Yeah, transactions are always first. Every time that we have had price corrections at least in the existing home space.
Right.
Even in the 1990 recession, going into 92, that was a big part of why Bush lost was real estate got soft.
Yeah.
And instead of being, the majority of the South, it was the Northeast that got hit really hard. But it takes time for that to happen, number one. And number two, you're right. It's we've had periods where prices sort of stall and they
Right.
stop expanding and they flatline for a couple of years. And throughout the 80s was notorious for that.
Yeah.
Um, Across the country, you had crashes in certain areas like Portland and Seattle. You had crashes in Houston.
Hmm.
Um, Energy crisis. You had crashes, continuing crash in Detroit. It never really stopped.
Yeah.
Uh,
Yeah.
St. Louis. But you're right. So there's a lot of areas that probably are going to experience that, like the early
Yep.
1980s, where it's going to be this 2 years. I think if we do see softness going backwards, it's going to be within the first 6 months of
Mm.
2025. And
Okay.
I think that we're retracing closely to that, to the 1990, 2007 in the existing market. But if we don't see that softening in the spring, then I would agree we're probably going to have more of that 1980, 1982
Yeah.
redux. It's just going to be stagnant. And I don't know that sales are going to pick up much from this year
No.
either. I don't see that they're going to suddenly grow, with higher mortgage rates or prices staying.
Yeah. No, again, another call that I made for 2025, again, just see how this lands with you, is I think we're going to post a year where we do less than 4 million existing home sales. And
I
it's
agree
really because,
100%.
oh,
Yeah,
yes.
yes, 100% agree. I think we're going to be in the 3.5 range again.
Oh, wow. Okay.
Uh,
Yeah.
and
Could be.
maybe if the year softens, like I said, at the end of the year with rates coming down, or if we do
Yeah.
get the price correction come springtime, maybe that changes. But I don't know that it's going to go over 4. I think
Yeah.
3.5 to 4 is way more realistic of a
Yeah.
call than anything over that, or even under. I mean,
Yeah.
under 3.5, that's already, we're talking about 30-year lows. So
Oh, yeah. It's depression. I mean, when you adjust for population,
yeah,
it's
right.
crazy, right? It's just wild. But again, and when you study 78 to 82, it was 4 years to get to the bottom. And it's funny. I
Yes.
just reported this morning. I want to make sure I get the quote right. I have it in my daily. Lawrence Yun, that great chief economist at National Association of Realtors, he's out saying the worst is over. Affordability will get better and inventory to increase. And I'm like, Lawrence, sorry, buddy, you got one
Yeah.
more hard year. It's probably
Yep.
going to be the hardest year. It'll be I think it'll be the bottom of transactions. I'm more like 3.7 to 3.8
Sure.
million, again, existing home sales.
Yep.
And then 2026, interestingly enough, might just be 4 million or maybe 4.1,
Sure.
which is still historically low. But when you start to look at it on year, it'll
Yeah.
start to be year increases. But then it could be a decade before we get back to 2022 levels.
Yeah.
It could be that long.
That's the thing when you study cyclical patterns, right? 1968 to 1970, it was 2 years. 1973 to 1975, it was 2.5 years. Really, like you said, 78 to 82, 4 years.
Yeah.
It was really 1989 to 1992. Even going into the election, Clinton was talking about still being in a recession because
Yeah.
Denver hadn't ended it yet, even though it was long past. 2001, and 2002 had some depressed years, but it wasn't anything like the other cycles. And then, of
Right.
course, everyone talks about 2007, 2009, but as you well know, it was really 2006 to 2012.
Correct.
Was terrible for real estate. For in a traditional metrics as far as existing sales go.
Yep.
Prices on mound for more than 2.5 years. It was all the way into 2012 when things really stabilized. So
Yeah.
yeah,
Oh,
you're right. Cyclically, those are real patterns.
yeah, I love this. I love this conversation. It makes me feel good that I'm looking at the right things. One thing I did get wrong, because I always like admitting when I got wrong.
Yeah.
It brings authenticity. I called it. This is the second year in a row I called a recession in 2024.
Oh, sure.
So I got that wrong. There was no
Yeah.
recession in 2024. It
Yeah.
doesn't feel like one will be backdated. It just doesn't
Yeah.
statistically look like it. So I'm not making a call anymore. I figure I'm getting it wrong twice. I'm just going to wait for one to happen.
There's nothing wrong with that. There's been a lot this year, a lot of data that has led me to believe that we are going to have one backdated. But I've got a new piece coming out that is going to land hopefully next week. That's got some other data in it that does make me think that maybe that's the case. Maybe it's not going to get backdated this year, but we're perhaps on the precipice. But either way, we're definitely not seeing the growth that
Correct.
everyone's used to, right?
Yeah.
Even if
That,
we're talking about we're growing at 2.5% GDP per year, I don't think that, you know,
yeah.
the,
I agree with you.
it's not showing up the way that everybody would traditionally think it is. The stock market seems to be doing well, but
Yeah.
there's a lot of other areas of the economy that are stagnating.
Yeah. So much there. So one of the things that I'm calling for, and this is more of a hope. I actually said this at Resi Day in New York with Lance Lambert. He asked all the speakers, like, if you had a magic wand, what would you do to fix the housing market? Right, the housing market's
Oh,
broken.
sure.
And I said, I would find a way to incentivize, encourage, whatever the right words are, to have home builders build smaller homes. Right.
Ah,
We haven't had an era of entry-level housing development since the 70s. And what we're seeing today is the broken housing market is most acutely felt, in my opinion, at the low end or the entry level, because people they're just not moving, right? Turnover rate's going to be historically bad.
yeah.
So one of the things I think will happen in 25, hopefully, is the average size of new home sold will
Hmm.
fall, let's call it 5 to 8%.
Sure.
That's something I'm hopeful, and I'm putting it
Yeah.
out there as good karma. But do you think that's possible?
I do. I also don't think 5 to 8% would be anywhere near enough to get to where that
Yeah,
magic wand starts happening.
no,
I
true.
think
It's a trend in the right direction.
right. I can tell you from being in the world, outside of Macro Ridge, one of the things that I've done over the last couple of years, I've been managed crews, working for big home builders, and a lot of consulting for developers. And I actually came out of LGI Homes.
Mm.
I managed Minnesota for them, so I'm no stranger to the home building world. Everybody is talking about reducing footprint size
Oh,
and
good.
cost, but there's sort of a catch-22 because to get to the size that we need for affordability, I call it the post-war special, right?
Hmm.
Going back to
Yeah,
World War II, the 800 to
correct.
1,000 square foot house.
Yeah,
Everybody could build that right now at a price point at current rates that we'll call it the median income can afford.
agreed.
The
I
median
agree with you.
median household does not want that house,
Hmm.
and the people that have built them wind up struggling to sell them because it's not a desired product, despite it being perfectly functional. It's just we live in a different world.
Yeah, but that could change, right? I think there's Gen Z and millennials coming up, and you're absolutely
Oh,
right. Everybody wants the 4,000 5-bedroom 4-bath house, but the kind of champagne taste and beer budgets.
yeah,
Sometimes you got to move into the you got to buy the beer. You can't afford the
right.
champagne. Um,
Well,
the other option's
that's
rent.
that's certainly that psychological change where whether it's new or existing starts to improve. It's going to
Mhm.
be people saying, "All right, well, you
Exactly.
know, I'll buy the champagne of beers budget rather
Right.
than champagne budget."
Yeah. I think again, and one of the things that again, I've studied the consumer for 30 years is tastes do change, but they change
Yes,
a lot slower
yes,
than we probably want.
right.
So
It's not an overnight thing at all.
no, it'll be years. But again, I don't see the housing market getting back to 2022 transaction levels for 5 to 8 years. Total duration. It's I mean, because if you look at 78, we didn't get back to 78 on existing home sales until 96.
Yeah,
Right? We were at 4 million. We don't get to 4 million existing home sales until 1996. That's wild.
that
It took
is
that long.
actually.
Yeah. So it
Yeah,
might be 94, but I think it is 96. It's
I
crazy.
would agree with you though. I don't think it's going to be soon. I don't think it's
No.
within the next 2 years. Certainly, I think there's a chance it's in the next 4 years, but maybe
Yeah.
it is out to eight. Where um,
Yeah.
and there's going to be things that go along with that too, right? I think to your point, in '95 or '96, rates had dropped a bit.
Hmm.
22, obviously, historic low interest rates.
Correct.
So there were factors that were involved in those sales volumes that
Hmm.
historically aren't involved any other time.
Yeah. So let's talk about price. I know there's a lot of people, like to forecast and make calls. Resi Club, as you know, Lance Lambert, he did I
Yeah.
think it was 16 or 17 experts calling. What
Yep.
is your and Macro Edge's call for median home price in 25?
Yeah, so we did a forecast for the Case-Shiller Home Price Index on an annualized rate, and our call is for it to be negative 0.5% on an annualized basis for this next year. And we think that takes into account um, historical time periods where
Mhm.
we looked at where things are trending most similarly to both the 1990
Yeah.
home price index correction, which was not nearly as severe or steep as 2007, which I think there's a lot of misinformation. And I hate that term, but there's a lot of misunderstanding about what
Mhm.
happened in the GFC, and then that
Yes.
correction for the home price index as well. So we think there's going to be some softness there this year, and then we also put an upside. We think the best case for appreciation in the case Schiller is going to be 1.5% this year.
Yeah, that's exactly. It's funny you brought that number. That's the exact number I've said, 1 to 2%. I just
Sure.
think it's just a crap year. It's just, not a lot of
Yeah.
transactions, not a lot of movement. Affordability is, second worst ever, only 81 being worse. It's just a rough year. In fact, it's funny. I've told people I think there's only two winners in 25. If you're a new home builder that can solve the riddle for
Sure.
building and selling entry level housing, you're going to clean up, right? If you
Yeah.
can solve that, if you can find that magic floor plan or whatever,
Yep.
you're going to crush it. And then unfortunately, it's investors who do the work and find motivated sellers,
Yeah.
right? If you're going to go write what I call disrespectful offers, 20, 25, 30% below list, been on the market for 90 days, maybe look for some seller, carries, just all of the hard grinding work that good investors do. I
Right.
think we're going to clean up because I think what will happen as demand stays constrained, this, some people have to sell.
Yeah. Oh, absolutely.
and and
There's
if you
always
have
the
to
still
sell,
stumbling. Yeah.
yeah,
That's kind of the interesting thing to me, though, about what doesn't matter what the time frame is. And even over the last couple of years, people have been saying terrible time to develop, and I've heard that from people all over the place.
mhm,
But I've run analysis for them where if they just adjust a couple of things, they've actually got good deals on their hands for new developments. But
yeah,
the same is true for acquisitions, whether you're talking about residential or commercial. If you're putting in the work, I, yeah, you're gonna chances are you're gonna be fine. Uh,
yeah,
but that's like everything, right? If you
yeah.
put the work in, you put the effort in, you're gonna see the results that you, or at least closer to the results that you want to see than if you're not.
Yeah, real estate's never get rich quick. But the whole key to this business, having been buying deals for 25 years, is to make your money when you buy. And the best way to
Yeah,
do
oh,
that is from a
100%.
motivated seller.
Absolutely. Yeah.
It's that simple.
I would agree with that. I think the majority of everybody I've ever known that has made any money in real estate, the money is made on the buy.
Correct.
It's never on the sale, right? I think everybody that sells where they feel it's the top or they got a lot of money, they're happy about it, but they always come back and say, it's because of what I bought it for.
Of
It's the
course.
basis, right? The initial
Yeah.
basis is always the reality there.
Yeah, I love that. One of the things that I think is funny, folks like Ken McElroy are talking about this now, but I put it out there 18 months ago and actually was interviewed by Ken McElroy. People can find that on his podcast. Is the similarities between what's going on in the commercial multifamily space and the GFC. I don't know if you
Sure,
spend a lot of time focusing there, but
I do.
it's almost comical to me that we repeated the same stupidity in this new asset class that we
Yeah,
did, I don't know, 12 years ago or whatever, 13, whatever, 15 years
but on
ago.
a way bigger scale.
It's
And
going to be worse, man. It's going to
yeah,
be worse.
I would argue on that front, it's more like the 73 to 75 recession on the
That could be.
numbers.
Yeah.
And that's where a lot of people that are, studying and talking about it, they're not focusing on real estate from that perspective. But multifamily during that 73 to 75 recession, that was a train wreck. There were
Oh,
investors that got
horrible.
wiped out left and right. It shook up the real estate world across the country. Um, and it was sort of the basis for a lot of legislation changes in the 1980s,
Yeah, it sure
just
was.
to respur investment in different real estate classes because of how bad that situation was. And that was a huge part of why construction employment fell the way it did because we were building so many apartments left and right that when that stopped, it was like, oh, well, there's no job. home builders, guys are building houses for their wages.
Right.
There weren't profits there because there was nothing else to go to.
Yeah. And again, let's for folks that don't know what I'm talking about, when I stand back and compare the GFC with what's going to be bigger than the GFC from losses, in my opinion, is short-term debt, right?
Yes.
They were called ARMs in the GFC, pick a payment, just toxic pick a payment.
5-year floating rates.
Oh, just horrible. Today we got bridge debt, 1 year IO, just same thing. We had horrible assumptions. I remember going to cocktail parties and events in 06 where people were flipping contracts, right? People would buy a house before it was built. They'd sell it again and they'd sell it again.
Sure.
Oh, and they're doing the same thing. Like there were multifamily assets that were sold 2 or 3 times.
Yeah.
Like in a year, same stupidity. And
Absolutely.
then horrible assumptions, 5% rent growth, flat tax. It is just going to blow up spectacularly. And right now it has happened to some extent in Class A. I would say Class A multifamily is down 25-ish%.
Sure.
But you just wait till Class B and Class C trades again, which it's just locked up because there's no value discovery. It could be down 50%. Like you said, 74. It could be down 50.
I agree with you 100%. And for everybody watching, listening, I just want to concur with that. And we've got this situation now where Class A, you're right, is starting to be impacted, and people are saying, well, Class B and C are going to be fine. And I've read that over and over, and I'm thinking,
I have too. I'm like, you guys are morons. No way.
You're talking about something that was like 1968 multifamily that has not had the maintenance put into it that it needs ever, let alone the last 10, 15 years. And you're telling me that somebody in today's environment is going to say, sure, I'll buy it for even more than what you paid for on the floating rate. No, I don't see that being the reality.
It's going to be a disaster. I've done some back of the napkin math, and again, Class B and Class C, I'm saying it now and saying it loud. It'll go down 50% once it starts to retrade. And right now it's just not trading.
On a cap rate basis, do you have a target or that you're thinking of, or what are your thoughts?
So
on that?
I only can know my market, right? And we can extrapolate my market being Central Valley of California. And I actually have assets there. So what happened in my market? My market usually for the stuff I buy trades at about 8.5. Okay. Usually is an 8.5.
Yeah.
I sold stuff at a 5 to 5.5 because I'm like, these freaking people are crazy. What the hell are they doing?
If they're going to give you the money, then
I'm like, I don't want to rewire the entire building, so I'm going to sell it. Let the next guy do it.
Sure.
I sold early. They went down to like 4.5. So again, nothing is trading yet. My spidey senses say it's got to revert to the mean, which means we're going to go above 8.5. We're probably going to see 9.5. And dude, we might see 10. And that means the prices get cut in half or more.
Yeah, I agree with you, actually. I have no argument for that. There's a lot of the things I've seen go in the 4 and 5 ranges.
Crazy.
When they've come across my desk or somebody's asked about it, I look at it and I go, what assumption are you making that you're going to come out on top? I don't get it. It mathematically doesn't work.
So I don't know if you've heard this story, but I've seen this movie up close and personal. So there's an apartment building that we still own today. Yeah. It was listed for sale. I want to call it 2006, might have been 7, for $1.44 million. It's 18 units.
Okay.
And why was it listed for 1.44? Because the guy bought it at 1.44 in 2004 or 5, right? When prices were bubbling. And, he wanted to get out for what he paid for it. He got in, so he listed it, which bought him time with the bank because the lender wanted to be paid back. The debt was due. The lender gave him 6 months and then gave him another 6 months. But what happened during that year is the guy who owned it stopped doing maintenance, to your point, because he knew he was going to lose it. So he stopped even doing the simple things. Yeah. So when the bank finally went back to review their assets, shame on them, they realized that they didn't have a choice. They had to foreclose. And then they ended up selling me the building for $700,000.
Good on you.
That's the stuff that's coming.
Yeah, and that's the work that you put into where you're looking for opportunities where there's distress, and that's how this business. That's the right way to do it. I'll put it that way. There's a million ways that you can
Yeah.
be involved in real estate, but that is the best way, 100% the best way, in my opinion.
And the
Um,
story behind this, again, everybody wants the crash now. The story
sure.
behind what I've just described is, again, the owner at 1.44 knew he was in trouble, but the
Yeah.
lender didn't want to foreclose because the lender knew it was probably worth about $1 million at that time, and they
Sure.
would take some haircut.
Yeah.
So they got an extension and another extension. So again, what the reason that B and C aren't trading right now is because this little slow dance,
Extension. That's right.
right, between banks and owners. And I can tell you, most owners are going to be like that last guy. They are not going to
Yeah.
fix crap. And it's
And
just the asset's going to go like this.
absolutely. And to your point, even banks are that way. Nobody wants to take a loss. So, I've had people ask me
So they
lately,
take bigger ones.
yeah, why are they extending it? Well, because as long as they think that they can extend it and hope that some situation changes, they're going to, until they have to stop extending it. Because
Yeah.
nobody wants, right? Nobody
No,
wants to lose
nobody
money.
wants a loss. Yeah.
They're not out here going, "Hey, pick me. I'll take the big loss."
Yeah. So it's going to be a lot. So it's really interesting. I was starting to see syndicators because I've been calling for pain and screaming at these syndicators for robbing people for a while now. They started to get a little, I don't want to necessarily say cocky, but they were feeling really good when interest rates were like 6% or 6.1 because they're
Yeah.
like, come on, 5. Come on. I can be bailed out at 5. Now we're at 7 and we're going to be at 7 all year, according to me, next year. So some point in 25, we're going to see a bank say enough is enough.
Yeah.
And if you remember anything about the GFC, the first bank to take the haircut actually wins. They take the smallest loss.
Yeah, absolutely. It's kind of like first in, last out, or last in, first out.
Yeah, last
if
in,
you're the
first
first
out.
one to go, okay, I'm going to cut my losses here and start over,
Right.
then, right, that's a smart money. You sell it before anybody else does.
Yeah. So it hasn't happened. It is coming. It has to come. I think the amount of LP money equity that's going to be lost in this is going to be,
It's
it's going to be
fascinating
horrific.
what happened post GFC in that space, isn't it? Because we've
Yeah.
always had partnership groups and tenants in common going back in the day,
Yeah.
and different ownership structures, but the GP LP structure that really rose out of the remnants of the GFC was
Yeah.
a lot of it trading on the basis of interest rates, where they're going, hey, it's a 2% interest loan, so 4 cap works,
Yeah.
and they're looking at like, well, if we're making 5%, but as you know, if you're talking about 5% on 100,000
Yeah.
units or even just 100 units, right?
Yeah.
5% can disappear real fast with increased costs, change of interest rates, refinancing.
Yeah.
It's
Cost of capital,
nuts.
NOI is going the wrong direction, right?
Exactly.
NOI is taking a massive hit, and it will continue to take insurance, taxes.
Oh, absolutely.
It's
That's another thing. I don't see anything that's going to slow insurance increases in 2025.
yeah, it's
It
certainly
just
not
seems
going to
to
go
be,
backwards.
yeah. I mean, everything that I'm seeing and reading is rates. They're not done going up. There's going to be increases, certainly in the South region,
For sure.
and
In the
then
South,
we're also
yeah.
going to catch up to make up for differences for insurers too.
Yeah. Yeah. Again, this is why I'm telling people. I'm actually telling people in the real estate and mortgage industry that 2025 is going to be the last hard year. And the reason I've said that, we talked about earlier, transactions, but I think the other thing that happens this year is we get that final flush out of real estate agents and brokers and all of these folks,
Sure.
so that when we get to 26 and it's 10% better,
Yeah,
you're just gonna gorge because there's nobody else at the buffet.
we might be there. Yeah, that's coming. I'm not sure if it's next year, but
Yeah.
I 100% agree with you. Whenever we get to a point where there's a bottom and we've cleared out a lot of people that were just in on the last end of the cycle,
Yeah.
all those people,
It's been
it's going to
4
feel like
years. Yeah.
manna to them.
Yeah,
It's
exactly. Yeah, and I'm hoping, guys, it's 2026 for you, because again, I don't have great calls for 25, 3.8 million, but again, if we go from 3.8 to 4.1, that's not a great number, but it is up, 15%. So if
And,
there's
and
half
if
as
you're
many
talking
people,
about, yeah, half the brokers, then that's not
feels
too
good.
bad for people that are in the industry.
Yeah. So that's my silver lining for folks is hold on for one more year. It'll get better in 2026. That's funny. So if I were to kind of summarize where we're at with kind of 25 residential real estate, no crash, right? There's people, the 13th year of crash bros,
Yeah.
you're like down 0.5% to up 1%. Certainly
Yep.
can't call that a crash.
I think like I said, I think there's a potential for it this coming year.
Okay.
But I think the first few months of the year are going to bear that out. And I say that because of the trends in the data that I'm studying, both in price changes, rate changes, and unemployment changes that are tracking close to 90 and 06.
Okay.
There's a potential for that. But again, if it doesn't happen within by springtime, May, June, then yeah, I think then we're just repeating the other flat top cycles where it's just compressed and we're not expanding. It's just flatline basically.
Yeah. Painful sideways motion. But when you look at the commercial
It's
market,
commercial.
yeah, the question that I have on commercial is like, when does that first bank cry uncle?
Yeah.
And I'm guessing second half of 25, but that's just a guess because, maybe it's 26, but I'm going to guess second half of 25. What do you think?
Yeah. One of the things that makes me curious about that and why we might see the first half have softness, we've got bank term funding program ends in March. Now that's for bonds, but if we're talking about banks already having to take billions of dollars for bond losses, extensions, that's not addressing any of the real estate that they have that's performing.
Can you imagine the mark to markets on that stuff? Oh my God.
So now you're talking about loans needing to be repaid by the end of March. That program goes away. Interest rates are still elevated, and I think we agree they're going to be at the 7% in the springtime.
Sure.
So there's a recipe there for backwards and for bigger issues for banks in the spring.
Okay.
But so far they've been able to extend and modify and survive. Maybe bank term funding program was the thing that they needed, and that was going to get them to where they can take whatever losses they are and not have a catastrophic disaster. But
I am not hopeful.
I'm not either, but I do my best to look at it from all sides and not just say it's going to be terrible or everything bad is coming out there. I think there's a lot of value to offering some hope, even if I think the situation is going to be terrible.
Yeah, they could always extend. I mean, they could easily push this to 26. I think there is a day of reckoning. To me, it's like 25, 26.
Yeah.
Not much more than that, I don't think.
I would agree with you. I think that, we'll just call it the next 24 months are really where a lot of the softness in banking and real estate are going to be seen.
Yeah, I agree with that. So I'm curious, what are you looking at in the first 90 days that got you kind of your spidey senses saying this might be, the early part of the year is something to watch? What are you seeing?
Sure. So our delinquency rate, if you break out each economic cycle, and I study the real estate cycle in new home building in particular a lot, and we had 2000 and 2020 were very similar, or 2001 similar recessions where they were not particularly real estate driven, where most other recessions real estate has been basically the underpinning of the U.S. economy. But if you look at from 1999 into 2006 and 2017 to current, so the same time periods, the overall delinquency in real estate in all commercial banks, so not just residential, not just commercial, but all of the delinquency, it's almost identical to where we were in 2006 for the same time period, and it follows the exact same trajectory.
So let me poke at that a little bit because I love this conversation. I'm going to just completely guess that the kind of that 07 or that initial time frame was a lot more residential. If you were to break the pie up, residential versus commercial, and today a lot more of it's commercial. But again, I'm just completely guessing.
You are correct. So it was more residential in 2006, followed by commercial, and it's more commercial this time than it is residential. But the overall delinquencies are nearly identical.
Yeah.
And to your point, as you were talking about, GFC wasn't just about houses trading for less. There was a lot of commercial assets, whether it was
Absolutely.
multifamily, retail, office, all of them were getting haircuts as well. And
Yeah,
then
you know
the other
the other interesting thing that again, this is a guy. I'm a guy that was in the business of
yeah,
buying these distressed things. I don't know if you see this in the data for that for what people call the GFC, but residential properties got hit first and hard.
yes,
Just like my story with that apartment building, I didn't start to see multifamily again transact, unlock, unfreeze for about 2 years.
sure.
So I was doing all houses and, residential loans like duplexes and the like for 2 years. And then all of these apartment buildings started to crater.
Yes.
So that's interesting to me. I just thought about that.
Yeah. So I think maybe there's the reverse this time. Maybe we see more of the commercial and multifamily first and residential secondary.
Oh, that'd be
Um,
interesting.
but that was similar to the 1990 situation as well, where 1988 to 1992, 1990-92, both existing and new home markets were not good, and there were price corrections nationwide. It wasn't just regional.
Yeah.
It was hardest hit in the Northeast. But we had come off a decade of farmland absolutely being eviscerated.
Yep.
Basically, by the end of the 1980s, farmland was worth a tenth of what it was at the start of the decade. And in 1988, 1989 legislation of FIREA was introduced, which created the Resolution Trust Corporation because of how bad the commercial market had gotten in '89.
Yeah,
Commercial led
RTC.
the
Yeah,
residential,
you're right.
having to dispose a lot of not just mortgages, but properties in general. All the office space, all those apartments that we built in the 70s, 80s, basically we needed a government-sponsored entity to say, okay, we're going to dispose of all of this. And it took them 5-6 years to get through it.
Yeah.
But commercial and multifamily led the 1990, and then it was 90 to 92 that residential saw a softening.
That's interesting. I'm going to look that up. I've never thought about that before.
Yeah.
In my mind, there's no question that commercial is going to lead this. I had not put that together to see how that might roll into residential in the years to come. I'm going to look that up.
Sure.
That's going to be fun.
One of the things, some fun info on there too.
Oh, yes. I got people that send me data. I like it. Thank you. One of the things that I see coming is, I don't know how else to say it, bank consolidation, right?
Yeah.
Because again, these balance sheets are, I think, in tatters, or just, no mark to market going on, extend and pretend. I think we could see, I don't know, triple digits, 100 banks get kind of gobbled up in as we kind of get through this. I don't think it'll be kind of like the savings and loan crisis, but we're going to see a lot of consolidation, I think.
I don't want to agree with you, but I can't argue that because I actually see the same thing. And it kind of seems as though that's sort of been a never-ending path since 1990, where we keep consolidating banks.
Yeah, less and less. Yeah.
Graham Leach Bliley in '99, which opened the door to merge banks and insurance and create super banks. Just ever since then, we're on this downward trajectory. And then, of course, it consolidated again, GFC. We've seen some weakness in the last year. Obviously, there were some mergers in 2023. Yeah, I agree. I think, unfortunately, we're going to see more consolidation in that space.
I just don't know how you can't.
I mean, doesn't want that. I think that's almost a desired effect, unfortunately.
Yeah, it's again, when you kind of step back and you look at the commercial banks who've essentially stopped lending for lots of projects. Their balance sheets are full of, I guess, I don't think they'd call them toxic, but it certainly looks like toxic debt to me.
Sure.
It's like, this stuff's not valued at what you have on your balance sheet. And, there's going to be a time that comes due. So yeah, that's going to lead to consolidation.
Looking at, commercial mortgage-backed securities, collateralized loan obligations. I look at data from TREP and from Credit IQ frequently, and we're already over the 10% delinquency rate in a lot of these. So if you're telling me that, all these syndicated bonds out there are at 10% delinquency, but somehow what's being held on real estate banks, that
Hmm.
they're the only ones going, no, we're fine. 2%.
No.
Okay, I don't know.
Yeah. That's it. That's interesting math is all I'll say.
Yes, it is.
Yeah, interesting math.
The one thing that does, I've looked at and said, okay, well, maybe there's still a lingering effect. There's the residential portion, because we've had 4 years of continued legislative and administrative efforts to prevent any
crazy
delinquency
levels.
or foreclosure.
Yeah.
So, what is the overall effect that we've had there? Because I think we've had suppressed delinquency, and given that we're already at the 2006, identical markers, that's another potential area of weakness in 2007. Whether that commercial leads it, and we see residential later or not. But
again, I don't have the data. It's certainly a wild card. All of this is a wild card. I just can't imagine, again, having lived through there's two things that happen. In the residential space, it is clear as day, banks are not going to repeat what happened in the GFC, right? In the GFC, if you were 90 days late, I think it was a 94% chance you were being foreclosed on or short saled. Now they give you a 6-month extension with a click of a mouse.
Yeah.
Right. It's just, they're treating it completely different the last 3 or 4 years.
At the onset for sure, but once we got into 2010, there was a lot of that going on where they were saying, okay, we're going to foreclose, but it's not going to be for 6 to 8 months. And then there was even foreclosures where the banks had foreclosed and they were telling the homeowners, hey, please don't move out, just stay there until we can deal with it. And there were people that stuck around until 2012 that hadn't paid for their properties for 2 years, but it was because it took banks that long to get to it. So
I knew a couple people in the Fresno market that didn't pay a mortgage for 6 months or 6 years. 6 years.
I knew some folks here that the same thing, and then it was like mid 2012, 2013 rolled around. They're like, well, we're finally moving. It's been a while. So
it'll be interesting. Yeah, because I can't see residential leading this time, but I'm definitely going to study commercial leading to residential and look at the time lags in that, because that'll be interesting to peel apart. Let's talk about unemployment. I think one of the big wild cards out there is unemployment. And again, I'm really stuck in, because so I was born in the early 70s. So I was just old enough to remember 81, 82.
Sure.
And what I remember from that era is my father was unemployed for 9 months.
Oof.
It was, and my mother was a stay-at-home mom. So it's not like we had any other. So it was, it was a very painful era. And I admit to having PTSD and having one meal a day, which is a baked potato or ramen. That was all I could have.
Right.
And my fear for 2025 is the unemployment rate doesn't go up meaningfully. Okay, what does that mean? I think we stay below 5%. But the duration or continuing claims
continues to expand.
Oh, dude, that could go, because I think I saw it this morning. It was 1.9 million. It could go to 3 million, 3.2 million.
Yeah.
That is my big fear for 25 is unemployment rate stays, sub 5%, but duration of the folks that do get unemployed doubles or heaven forbid triples. Oh, that's not going to feel good.
No. And it has been expanding. Consistently for months, it's taking longer and longer for the continuing claims that the employed insured. It's been expanding. Maybe we don't see a huge increase in unemployment rate. To your point, I think we will, but slower than what we've seen in the past. And part of that is different work options that exist now. And then the other one I don't see get talked enough about is there are a lot of states that change their unemployment post-COVID responses. And we've got 10 to 15 states that their unemployment benefits basically amount to a quarter of minimum wage. We're talking about like $180 to $200 a week.
Oh my gosh.
And I don't know how what are you going to do? I mean, there's a lot you can do to make $180 to $200 a week rather than jump through the hoops for unemployment and then not get it if you do the other things anyways. Florida being one of those places. So, their unemployment rate's not going up because Florida's, their unemployment insurance is
nothing.
$200 a week. What are you
Why
going to do?
bother?
Yeah, exactly.
Well, that is interesting. I didn't know that either. I'm gonna have to dig into that too. And when I peel this together, the other thing that I've been playing with as an economist, and this is just theories, is I'm trying to ask myself why most economists have been wrong the last couple of years, right? The economists that get quoted a lot, we've all been wrong on lots of things. I've already admitted several on my end. But I think the thing not being asked is, I think the structure of our economy is fundamentally different in 24, 25 than it was 2019. And I think there are structural differences that aren't being picked up in our models, that aren't being picked up and really understood. For example, I mean, I've heard some doomers talk about, I forget what the number was. There's 1.3 million males not in the labor force. I've heard things like that. But I ask myself, maybe they're solopreneurs. Maybe they're doing what maybe are called side hustles as main hustles. To your point, there's lots of ways that you could make $200 a week or whatever it is. And I'm wondering, one of the things I wonder is just the ways of making money haven't made it to our models yet.
Sure.
And I think that's worth. The other one that I think about is this work from home thing has fundamentally changed, where people live right now. Yeah. I know there's people like Amazon and a couple of tech companies saying, get your ass back to the office. But a lot of people are like, oh, this work from home thing's cool. We can have less office space, lower our overhead, yada, yada, yada. And again, if you look at the structural, work from home thing, people can live an extra half hour or 45 minutes out of the city. Cause hey, if you only got to go to work once a week, you're willing to make the 2-hour drive, where you're not willing to do that 5 days a week.
Right.
I think there's some pretty massive structural changes in our economy that we're not talking about enough. And it's certainly not in our models. What do you think of all that?
I think to some degree that's true. Certainly the work from home. And I think where we are seeing that is the last year and a half of same store sales for restaurants being negative. You've got people that aren't going out for lunch or not getting coffee. And so we are seeing that in some places. And then we're going to see it even more in commercial real estate where, to your point, the ones putting the effort, the ones that are offering the right amenities, that have the right price points, those office or retail spots are going to do it right. The other ones, hey, someone's got to get a haircut there.
Oh, yeah.
The one big difference is for single earners, to your point, to be able to work from home or work remotely. I would agree with that. I think there are more opportunities to work remotely than there certainly were prior to 2020. And there's more of a psychological, what's the roadblock there?
Yeah.
Still, there's a lot of people saying, no, this works. They might even take less money to continue with it because it works for them. And that's definitely a difference. The other thing is, I would say, a lot of economists, maybe got things wrong, is things don't always move as quickly as anyone expects it.
We've been,
looking at economic data, going from week to week on claims, it's, it can, there's that saying, it's like watching paint dry. Yeah. Some of it can actually be like watching paint dry, and that's a reality.
Yeah. Watching weekly claims, I just reported this morning 219, last week 225. Definitely baselining at that 220 level. We did have that 1 week we popped to 242, but nothing to write home about it at the moment.
Of course, that's seasonally adjusted though. If you look at the non-seasonally adjusted data today, we're closer to 300,000 than we are 200,000.
Oh, I got to look that up. I did not look at that.
And January is traditionally our highest month, so there's a good chance on a non-seasonally adjusted basis, we're going to go over 300,000 in January. And same with not seasonally adjusted, that number was higher than for continuing claims than the seasonally adjusted number. So we're closer to the 2 million mark there already.
Yeah.
For that, so
So let's
to your point. looking at seasonally adjusted or not seasonally adjusted data or annualized. And I see that in home building a lot where they're making forecasts based on something that's annualized on a 1 month sales number.
Yeah, exactly. It's
Like
like,
if I were to take that to the board, if I were to have gone to division president LGI and said, hey, here's our annualized based on this 1 month, they would have said, there's the door, get out, don't ever come back.
Don't ever come back. Yeah, I love that. I love that insight. Let's end on what a lot of people on my channel are looking at: residential real estate.
Yeah.
And today affordability is horrible. Supply is increasing. I think it's up 17% year on year,
Right.
something like that. So you get more options. I do think if you were to step back and look at entry level versus luxury, I think most people would agree luxury is stacking up more than entry level because people are locked in. But in order for affordability to get better, there's only 3 things that can happen. Only 3: prices, rate, or wages.
Yeah.
And when I look out over the next couple of years, I think we finally have real and nominal wage growth. I think that continues. I think rates over the next couple of years maybe get us to the low 6s. So that'll be helpful. And I think prices stay kind of flat.
Sure.
So, if you go out 3 or 4 years and you have real wage growth, you have, rates down 100 basis points and prices are flat, that'll make affordability better, but it's not fast enough for everybody that wants a crash in residential. Do you see any flaws in that kind of math?
Interesting if we talk about the income, because you're right. Those are the 3 factors that, unless you happen to have a giant pile of cash to do whatever you want with already. But if you're talking about the median household, one of the things that happened that we've got 2023 median household income went to 80, but that's based on an increase that happened in 2022.
Okay.
And those conditions don't exist anymore. So we had a big jump 1 year in wages. I don't see that the wages are going to continue to expand at that rate.
No, not that rate.
In fact, I think the layoffs being elevated this last year are proving that. And then people being willing to take less wages to what we said, working from home. We've almost ended the opposite of that, where if anything, wages are going to stagnate for the next couple of years. So we really could be at level for 8 to 10 years, these transaction levels. Yeah, because that is what I see. Is I see wages are stagnating, and I'm seeing it in the real estate and construction industry already, where wages are suppressed from what they were hiring for before. But then if you're looking at rates, we've got another year of high rates incoming. So I don't see that. So what is the one factor that can change? Price.
Yeah.
And builders in the new home building world, it's going to continue this next year. I think, we're going to be below 380 or at 380 for the median new build price.
Dude, I hope it goes lower. My answer is get that thing down, folks.
I think builders are going to have to look at that and say, hey, there's no other choice. And we've got the, Heddle and R saying, we're good. Pace over price, because we've got them. Yeah, because that's the business. You got to crank them out. You got to move them. And if that means margin smaller, it's better than no margin.
Yeah, it's better than sitting on that capital and just waiting there, being eaten away. So we do have a new administration coming in. Rumor has it deregulation will be a big part of Trump's administration. I'm curious, and again, this is just a crazy question that if you don't want to answer, it's okay. But what if the administration created some kind of incentive to encourage, home builders to say, I don't know what they would do. I'm just going to make stuff up. We'll give you a $20,000 incentive for every house you build that's under 1,200 square feet or something. Because to our earlier point, we've got to get them to build meaningfully smaller homes. And one of the problems is it's maybe not profitable or as profitable. But if you get a $20,000 kick on top of every home, again, that's just a complete guess. So is there any incentive that maybe we can get these smaller homes coming?
I'm actually betting that there's going to be an incentive of some type.
Oh, sweet.
One thing that I have, and again, part of this piece of got coming out, it is all the different legislative efforts throughout the years going back to 1970,
Okay.
both on the upside and downside of the federal rate cycle. There is always legislation to spur incentive or to fix the problem. How much response is going to be, in my opinion, the determining factor. And I think it would have to be way bigger than the $20,000 rebate or bonus.
Okay.
One of the things that this administration was partially responsible for in their last administration, or last term, was the opportunity zone.
True. You're right. Yep.
And that was a resounding success from an investment standpoint. And to, as you and I talked about, that's part of why we have built more apartments than we did in that leading up to 73 cycle.
Yep.
There was a tremendous amount of capital formation going into opportunity zones. And that is good for the economy. It's good for jobs. But the downside of that is going to be something that we're dealing with as well. So if you're incentivizing one area of home building, it's not going to affect it across the board equally.
Correct.
And even if home builders manage to go, tell you what, you give us 50,000 for every single unit, we can live with that.
Right.
That might stabilize home building, and prices have gone down. We're going to see some loss of employment in that space, but that does nothing for the apartment world.
No,
we've been building 1 million units every year for the last few years.
The only way to fix the apartment one is years of non-building. That's the only way to fix that.
Yeah, 100%. Unfortunately, it's true.
Yeah, it's gonna be fun. Well, do me a favor. Where can people find this piece you're working on? It's going to be on MacroEdge. Where is it? And then tell us about your Twitter page.
Absolutely. So you can check out my work at macroedge.net. 2025, we are launching full version of RA Sites, which is dedicated real estate research through the MacroEdge group.
Nice.
You can also find me at uspropertyservices.com. That's my personal business as a consultant, contractor, and then at Mr. Awesome on X-Twitter. I share economic data, charts that I find interesting, and occasionally humorous content that at least I find funny. So some entertainment value.
There you go. Well, you're amazing. Thank you for coming on the channel again. The audience loved our conversation last time. I'm sure they love this one as well. Take care. Have a wonderful holiday.
Thank you. You too. Always a pleasure.